In this video, traders, we're going to look at how you execute stops can change a losing strategy into a winning one. Stay tuned. Hey traders, warm welcome to you. Okay, so stop losses. If you're a subscriber, by the way, I appreciate your subscription. You're going to know all about stop losses. We talk about them a lot, where we place them, why we should do this, all this kind of stuff. But it's an actual fact that depending on the strategy we're trading, the time frame we're trading, adjusting the way that we trade or way that we place our stop losses can change a losing strategy into a profitable one and vice versa. And I want to dig into that a little bit now in this video. So imagine we have a standard chart here. We're short, it's looking great, lots of squiggles, pullbacks, whatever we're in, and we decide, you know what, we want to put our stop loss here, lock in some profits and call it 50, whatever that may be. If it's a forex pair, it could be the last two digits on the pips, whatever. So we have that, and we then go, okay, what happens if the market chugs up to it? So the market chugs up to it, fine, we're out of 50. If the market spikes through like this overnight, we're going to be out at the first possible price if we have a stop loss in the market. So if we take number one as a scenario, putting stops into your platform, you are giving the broker an order that says, hey, when the price gets above 50, buy back my position, whatever position size that is. And so if we get to 50.1, you're going to be out. If we go to 55, you're going to be out there. So you are vulnerable to potentially an overnight gap up. Let's say no liquidity there, market gaps up on some news. The first possible price you get filled out is 55. That's an awful amount of slippage. Now, of course, if it then rips off to 200, you're good. If it doesn't gap and goes up there slowly, you're going to be out. So that's the advantage. Now, if, however, it was just an illiquid gap and it started to drift back lower, bad luck, you're out of 55. So that's the downside you have of putting stops into your platform. You are basically saying, get me out whatever. Now, that is undoubtedly the best way to do it if you are a new trader, if you have any trouble with discipline whatsoever. I think you can put up with the occasion where that happens. But the problem with this is that you don't have any more say in the matter if you don't happen to be at the screen. So you can't add any more rationale into the decision. So let's say it was a spike up and you thought, you know what, there's no volume here, it's overnight, there's no way that if I'm going to come out of this. And in fact, if you were there, you'd probably be hitting it short because you know it's just temporary blip. You can't see any other currency doing it. There's no futures contracts done it. It's just a fat finger. Bad luck, you're out if you've got a stop in. So that protects you against that. So the other thing you can do is using a mental stop, which is exactly the same thing, but this relies on you having the most ironclad discipline ever, because if it goes and it keeps going through, let's say it goes through and you don't execute the stop, you could sit with it. It goes against you, against you, against you, against you. The good thing is it means that if you see these sudden spikes, you're not just going to come out wildly. You're going to have time to think and say, is it genuine? Do I need to come out? Don't I? So let's say it does spike to 55. When you've got to stop into your platform, you're out whether you like it or not. If it's a 55 and you're using a mental stop, you can say, what do I want to do with this? It gives you an extra layer, but only if you genuinely can handle that. And that's not saying in a bad way. Some people just don't have the discipline to say, I'm going to come out of a position when I say I'm going to do it. And the third one you've got is X only at specific times. This is a great one. This is a great one for swing traders and day traders who are trying to elongate their time frame a bit. So you say to yourself, okay, I'm only going to come out of the open, I'm only going to come out the close, or I'm going to come out at the end of the week, for example. That means that if the price does something unusual, you have to sit through it until the end of the week. Now, you may have an emergency stop that if something goes crazy, you come out, don't risk losing money for the sake of it, but it means that you are taking stock of the situation. Maybe you get a one-day rally that looks quite strong. Then over the next 2 days, it declines to the downside. You know, if you had a fixed stop in, you'd be out. And if you had a mental stop, you might be forced out. But the fact that you're saying, hey, I'm only going to come out at specific times means that you've sat through that. Now, I appreciate if you're in full size, you can't stomach that. So you have to adjust your size to suit. You have to be able to ride 4 or 5 days of counter trend movement against your trade, and then potentially for it to come back. So that is going to depend, isn't it? This is where we get into the juice of a losing strategy into a winner, because whilst you might say, oh, I've got 100 pips stop on that, I guarantee I'm definitely coming out 100 pips. you might be in a market that's very range bound, and that 100 pips might just literally be grabbing the high and lows of the range in the wrong way. Whereas in reality, if you changed your stop loss to say, okay, I'm only going to come out at the end of the day, for example, then you may well sit through a 100 pip move and then retraces 50 pips. You're still in. The next day it comes down 50, up 50. You know, it leaves you in the position rather than crystallizing the loss straight away, just giving it that little bit more room, whether you are giving it a more room by using a mental stop and adjusting. In that scenario, it wouldn't make a difference, but this is a perfect example for it. Exit only at specific times. You're saying, okay, at the end of the day, I can stomach this amount of move intraday. I've allowed for that. I know the ATR of the trade of the instrument I'm trading. I've got my position size. Yes, I'm comfortable with that. I'm going to come out of the close, or I'm going to come out at the end of 2 days, whatever that time period may be, means that you are far better placed to, in the right market conditions, of course, for that to be a profitable strategy. And this is where things start to flip on its head. If you're constantly getting hammered in range bound markets by not picking the right thing, not getting stopped at extremes, maybe revisit and say, you know what, dial down the position size, either increase my stop or say, you know what, I'm not going to come out of the position until this specific time window. That then stops you as well reacting in knee-jerk reaction, going bang, coming out, you know, and causing that mindset issue, because you only trade during that period of time. And the final one is not using stops. Now, people might go, whoa, and you know what, for most people that's not feasible. I know that, you know, using stops is the best way to manage risk, but some people don't use stops. They manage risk by trading small size. They have hedge positions on. There are other ways of doing it. And, you know, like it or not, guys, studies show that actually when you back test systems that don't use stops generally far outweigh in profitability and performance those that do use stops. But, of course, you might have to stomach one of these. But at the end of the day, even if you had a stop, that wouldn't have helped you. You might have to stomach some significant drawdown. Most importantly, you've got to be so disciplined in the way that you exit. So maybe you've got an entry signal with some sort of indicator and an exit signal with some sort of indicator. You've got to wait for that to turn. And that may mean that on the odd occasion, you are sitting through a brutal loss. But studies generally show that that means that you sit through a lot of trades, you manage to profit, from a lot of trades that go against you and then come back, which you wouldn't have done because you're crystallizing the loss. So it's something to bear in mind. You know, if studies show that, it doesn't necessarily mean that the bottom line is always going to be good, because how can you sit through a massive, you know, 20 or 200 times drawdown the normal? It just doesn't make any sense. The system, even though it may be profitable, has sat through that horrible drawdown, which doesn't make sense. So you've got to find a happy ground for it, but it's something to consider. You know, a lot of trades, a lot of strategies that are losing actually turn into winning strategies when stops aren't used, or when you're using a different variation of it. So something to consider, whatever strategy you're trading, but whatever you do, manage the risk somehow. That's the key to long-term success, or being in the game for long term, so that you can learn enough to get to where you want to be as a trader. All right, guys, see you next one. Take care. Bye-bye.